I was looking at the screens this morning, January 27th, 2026, and I'll be honest with you, the whiplash is something I haven't seen in over a decade of trading physical silver and analyzing commodity markets. Yesterday, silver kissed $117.19. Today, as I was recording this, the ticker was at $110.53, a $7 plunge in 24 hours. And right on cue, the financial media is screaming the same tired script. Bubble burst? The silver crash is here. We told you $100 was the ceiling. They want you to believe the party is over, that the parabolic run was just another flash in the pan, and now gravity is doing what gravity does. But here's the thing that doesn't add up. While the paper price on your screen dropped $7, I spent the last 2 hours calling my contacts at bullion dealers and vault operators. You still can't find a 1,000-ounce commercial bar for under $130. Not in New York, not in London, not anywhere that matters. So let me ask you something. If silver just crashed, why are the vaults still bleeding metal? Why is the premium on physical delivery wider than it was when the spot price was at $117? The answer is simple. The crash is a coordinated illusion. And the trap, the real trap, is about to spring on anyone who believes what they are seeing on their phone. Now, I know there's been an explosion of AI avatar channels lately, pumping out scripted garbage and passing it off as analysis. That's not what this is. I'm a real trader who adopted this format purely for speed, because I can get you this information 12 to 18 hours before Bloomberg or CNBC even sniff the story. The avatar is just the suit I wear to broadcast faster. Think Iron Man, not a deepfake. So here's what I'm going to do for you tonight. I'm going to walk through exactly why we've entered a new era of triple-digit silver, and I don't mean that as hype. I mean it as structural reality. The $100 floor isn't a dream anymore. It's the mathematical consequence of a world that has physically run out of cheap metal. I'm going to explain something called byproduct inelasticity, the invisible wall that prevents new silver from flooding the market no matter how high the price goes. I'll run the deficit math, I'll address the unverified rumors about the Tesla squeeze, and I'll share my personal battle plan for navigating this $110 volatility. Now, stop for a second and actually look at what that vertical move was yesterday. That wasn't retail buying. That wasn't some Reddit forum pumping junk silver rounds. That was a systemic failure of the short positions. The kind of move that happens when a major institution gets caught on the wrong side and has to cover at any price. And here's the contrast that should make your skin crawl. Paper silver on the COMEX is down 6% today. The media is celebrating the cool-off. But while that number blinks on your screen, Beijing just announced tighter export controls on strategic metals. The United States Geological Survey officially classified silver as a critical mineral last quarter. China has turned off the tap to the west, so the paper price drops, but the physical world is tightening like a noose. And this is where everyone asks the obvious question. Okay, if silver is so expensive now, why can't the miners just dig more and save us? The answer is a structural trap that most people, including a lot of professional analysts, don't fully understand. And it's the reason why $110 silver isn't a bubble, it's a floor. Let me walk you through this slowly, because this is the single most important concept to grasp if you want to understand where we're headed. 70 to 80% of the world's silver supply is what we call a byproduct metal. That means it's not mined on purpose, it's a hitchhiker. It shows up as a secondary or tertiary output when you're mining for something else, usually copper, lead, or zinc. Think about what that actually means. A mining company doesn't wake up and say, silver hit $110, let's go dig more silver. They can't. Because they're not silver miners, they're copper miners who happen to get some silver along the way. Here's the trap. If they wanted to increase silver production, they'd have to mine 10 times more copper to do it. And if they did that, they'd flood the copper market and crash the copper price. It's a zero-sum game. You can't turn up the dial on silver without destroying the economics of the primary metal. Let me give you an analogy that might make this click. Imagine a bakery that only gets flour as a byproduct of making birdseed. That's their business model. They sell birdseed, and flour just happens to come along for the ride. Now imagine the price of bread hits $100 a loaf. Everyone's screaming for more bread. But the bakery can't bake more bread unless the entire world suddenly decides to buy millions of tons of birdseed. The flour supply is inelastic. It's locked to the birdseed demand, not the bread demand. That's silver in 2026. We are in the 6th consecutive year of a structural deficit. The world is consuming roughly 118 million ounces more than it is producing every single year. And because supply is inelastic, because it's physically trapped by the byproduct problem, it cannot grow to meet this $100 per ounce demand. I don't care if silver hits $200. If copper, lead, and zinc demand stays flat, silver production stays flat, period. Now let's run the math, because this is where it gets uncomfortable for the banks. Conservative scenario first. Let's say industrial users start thrifting, finding ways to use less silver per solar panel, per circuit board, per whatever. Let's be generous and say they cut usage by 10% across the board. Even with that 10% reduction, we're still short 118 million ounces per year. The deficit doesn't disappear. It just gets slightly less catastrophic. And here's the kicker. At $110 per ounce, the paper to physical ratio on the COMEX is still estimated, and this is conservative, at 300 to 1. That means for every ounce of physical silver sitting in a vault, there are 300 paper claims against it. Now let's stress test this. Let's talk about the elephant in the room, the Tesla squeeze. This is unverified, so I'm going to label it as such. But there are persistent rumors, coming from sources I trust, that Elon Musk's companies are buying silver directly from miners. Not from the COMEX, not from the spot market, directly from the source, locking in multi-year supply contracts. If that's true, and I want to be clear, I can't confirm it, then the COMEX loses its price discovery power entirely. Because if the largest industrial buyers stop playing the paper game and go straight to the mines, the exchange becomes irrelevant. It's just a casino for speculators with no real metal backing the bets. Here's the gap that doesn't close. We are consuming 1.2 billion ounces of silver per year globally. We are producing 820 million ounces. That's a 380 million ounce shortfall. Where's it coming from? Recycling? Sure, some. Government stockpiles? They're empty. The Strategic Petroleum Reserve for silver doesn't exist anymore. It was sold off decades ago. So let me recap where we are so far. We know the price hit $117 yesterday. We know the $110 dip today is a paper move. COMEX contracts getting liquidated, not physical metal changing hands. We know the supply is physically trapped by byproduct inelasticity. The miners can't save us even if they wanted to. So why is anyone selling? Why did the price drop $7 in a day? Because the paper shorts are fighting for their lives. And they're using every tool they have left to shake out weak hands before the final squeeze. Now, let's address the skeptics, because I know exactly what they're thinking right now. At $110, silver is way too expensive for solar panels. Manufacturers are going to switch to copper plating or some other alternative, and the industrial demand is going to vanish. The bull case falls apart. I've heard this argument at $50. I heard it at $70. I'm hearing it now at $110, and every single time it misses the same critical point. Copper plating, or any significant substitution technology, takes 5 to 7 years to scale at the factory level. You don't just flip a switch and change a multi-billion-dollar assembly line because the spot price moved on a Tuesday. These are supply chains that span continents, contracts that were signed 2 years ago, infrastructure that takes half a decade to retool. The thrifting lag time is the silver bull's greatest ally. By the time manufacturers can actually pivot away from silver, the deficit will have compounded so severely that even reduced industrial demand won't matter. And let's bust another myth while we're at it. Silver is a tiny market. It doesn't matter in the grand scheme of things. That was true in 2010. It's not true anymore. Silver is now officially classified as a critical mineral by the United States Geological Survey. It's a matter of national security. It's not just jewelry and coins. It's semiconductors. It's defense systems. It's the entire green energy transition. The market isn't tiny. It's essential. And it's running on fumes. Now, stop for a second and look at the dollar index again. 97.04. The dollar is losing its grip as the global reserve currency. When the dollar is falling, there is no such thing as too expensive for real assets. There's only devaluing currency chasing scarce resources. Silver at $110 isn't expensive. The dollar is just worth less. But here's the question that should keep you up at night. What happens when the exchange itself changes the rules? Let's talk about what happens next, because this is where it gets tactical. First thing I'm watching for, an emergency margin hike from the CME group. If the Chicago Mercantile Exchange raises margin requirements by 25% or more, that's not a normal risk management move. That's an attempt to force paper traders to liquidate their positions. They're trying to save the banks by shaking you out of your contracts. I've seen this play before. 2011, they hiked margins 5 times in 9 days when silver hit $49. It worked then because the market was smaller and the shorts had more ammunition. I don't think it works this time. The deficit is too large. The physical demand is too real. But they're going to try. Second thing, the media blackout. Did you notice how the $100 breakthrough barely made the front page? CNBC mentioned it in passing. Bloomberg buried it in the commodities section. The financial press is downplaying this on purpose because the vaporizing trust in the dollar is the real story and they can't say that out loud. When silver breaks $150, and I think it will this year, watch how they cover it. If they keep ignoring it, you'll know the institutions are quietly positioning for something much larger. Third thing, and this is the most important, watch the 1-month silver lease rates. Right now, they're hovering around 3%. If they spike above 5%, that's a screaming signal that the big players are panicking to find physical metal for delivery. Lease rates are the cost of borrowing silver for short-term delivery. When they spike, it means someone made a promise they can't keep. They sold metal they don't have, and now they're scrambling to cover. If those lease rates hit 5% or higher in the next 2 weeks, the crash narrative dies instantly, and everyone who sold at $110 is going to feel sick. So what am I doing? What's my personal battle plan in this environment? I'm laser focused on the $100 floor. That's my line in the sand. Trigger A. If silver closes below $100 for 3 consecutive trading sessions, the psychological breakout is invalidated. The market is telling me I was wrong about the structural shift, and I need to reassess. If that happens, I'm sitting on my hands. I'm not buying. I'm not selling. I'm waiting for a deeper washout to see if this was all just a gamma squeeze that ran out of steam. Trigger B. If silver dips into the $93 to $95 zone, the old resistance from late 2025, I'm looking to increase my physical allocation significantly. Not paper contracts, physical metal, bars, rounds, whatever I can get my hands on at a reasonable premium. Why? Because 93 to 95 is where the last wave of retail buyers got in before the breakout. If we retest that level and hold, it's a classic bull flag, and I want to be positioned before the next leg up. Now the margin play. If the CME hikes margins by more than 15% this week, I'm doing absolutely nothing. I will not be shaken out by forced liquidations. I will not panic sell because some hedge fund got caught off sides and has to dump contracts at 3 a.m. I will wait for the paper dust to settle, and then I'll reassess the physical market. Because here's my perspective on this whole thing. I'm not looking at the $110 price. I'm looking at the 46-to-1 gold to silver ratio. Historically, that ratio averages somewhere between 55 and 65-to-1. When it drops below 50, silver is outperforming gold on a relative basis. And when it drops below 40, we're in mania territory. We're at 46 right now. As long as that ratio keeps shrinking, silver is the lead horse in this race. I don't care if gold goes to $6,000. I don't care if silver pulls back to 100. As long as the ratio is compressing, the trade is working. We are in the end game of the paper markets. I genuinely believe that. The COMEX is running out of ways to suppress the physical reality with paper contracts. The vault inventories are at multi-decade lows. The industrial demand is accelerating because of the green energy mandates, and the byproduct supply is locked in concrete. Something has to give. And when it does, $110 is going to look like a gift. Let me bring this all together. Silver hit $117 yesterday. It's dipping to $110 today. The media says crash. The vaults say squeeze. The physical deficit is worse than ever. The miners can't produce more because of byproduct inelasticity. China has locked down exports. The United States has classified silver as a critical mineral. The paper to physical ratio is still 300-to-1. And while all of this is happening, the dollar is bleeding credibility at 97 on the index. Don't let a $7 move blind you to a 100-year breakout. This isn't 2011. The world has changed. The supply is finite, the demand is accelerating, and the financial system is out of tricks. Here's my rallying cry for you. The screen says crash, but the vaults say squeeze. The paper market is lying to you because it has to. The alternative is admitting that the emperor has no clothes, that the COMEX is a fiction, and that physical silver is the most undervalued strategic asset on the planet. I know this is a lot to process. And if you want to understand why $5,000 gold is actually the floor, not the ceiling, for this entire move, go watch my deep dive on the vaporizing dollar next. Because gold and silver aren't moving in isolation. They're moving because the currency is dying. Everything is connected. The debt, the deficits, the money printing, the loss of trust in institutions. Silver at $110 isn't a bubble. It's a mirror. It's reflecting the true cost of decades of monetary abuse. And if you understand that, you understand why this is just the beginning. Stay sharp. Stay liquid. And whatever you do, don't let the paper price shake you out of the physical metal you worked so hard to accumulate. Because when this thing really breaks, there won't be any metal available at any price. I'll see you in the next one.